Hi, Happy New Year. Ivan here with Isla Vancouver Wealth Management. For many people, the main financial goal is to save for a first home. Mostly young people, but really young and not so young. So in Canada, since the year 2023, the government introduced a new account type, the first home savings account. Some people call it the tax-free first home savings account, to complement other accounts like the RSP and the TFSA, specifically to help people save for a first home. Let's take a look. My friends at Fidelity explained the FHSA very well in this little piece that we're going to use. The main element of it is account holders are allowed to put up to $8,000 a year in an FHSA. The lifetime contribution limit is $40,000. You can hold this account for up to 15 years, and you pay zero taxes. You pay zero taxes if you make a qualified withdrawal, which we will explain shortly. And also, while the investments are inside the FHSA, the investments grow untaxed. There's a few rules, of course, like with any registered accounts. You need to be a Canadian resident between the ages of 18 and 71. So you need to not own a home currently and not have owned a home in the last 4 calendar years in order to open one. Contributions count in the calendar year in which they were made, just like it is with the TFSA. So you need to do it before December 31st. There's carry forward room up to a maximum of 8,000, carry forward from past years. And this contribution room starts accumulating the year you open the FHSA. An FHSA holder is allowed to claim deductions for contributions, just like it would in an RRSP. And any investment income and growth you earn inside an FHSA is not taxable. One can also transfer funds from an RRSP into an FHSA on a tax-free basis, but you won't receive a deduction, obviously. Any unused FHSA funds can be transferred back to an RRSP or REF if you didn't end up buying the house or make a qualified withdrawal on a tax-free basis, or withdrawn, but not non-qualifying withdrawals are taxable, much like would be an RSP withdrawal. So what is considered a qualifying withdrawal? You have to buy a home in Canada. There must be a written agreement in place to buy or build a qualifying home by October 1st of the year after your withdrawal. And you must intend to live in the home as your principal residence within a year of buying or building it. You must be a resident of Canada from the time of the withdrawal up to the acquisition of the qualifying home, and a first-time home buyer when you make the withdrawal. There is an exemption to allow individuals to make qualifying withdrawals within 30 days of moving into a qualifying home. So the FHSA is a great opportunity to save for a down payment. It shares elements of really both worlds, from the RSP and the tax-free savings account. To get the most out of your FHSA, it pays to invest early on. So if you max your $8,000 contribution for 5 years, you will end up with more money than if you save the same amount but in over 10 years, for $4,000 at a time. This is assuming the same rate of return. The FHSA must be closed by December 31st in the year that any of the following conditions are met. You either turn 71 years old, or it's the 15th anniversary of when you first opened the account and the funds have not been used to buying a qualifying home, or it's the year following the year of the qualifying withdrawal. If you don't use your FHSA, you can, as we said, you can transfer them to an RSP or a RIF, tax-free, or you can withdraw whatever it is left on a taxable basis because you got a tax deduction at the beginning, right? What's the best way to save for a home? Is it the RSP? Is it the FHSA? Is it the TFSA? I'd say all of the above. With the RSP, your contributions are deductible and the growth and the withdrawals are tax deferred. If you withdraw from your RSP, it's taxable. If you participate in the home buyer's plan, you defer those taxes. With the FHSA, your contributions are tax deductible and the investment grows tax-free and the withdrawals are tax-free if you're buying a qualifying home. For the TFSA, you don't get a deduction for putting money in, but you get to withdraw tax-free and your investment grows tax-free. And you can withdraw for any reason whenever you want. So if you would like to know more about the FHSA or any other financial question, I would love to talk to you. Let's keep in touch and please don't forget to subscribe. Talk to you soon. Bye.